20 attendees
Out of
already in the room, out of 70. Do we want to stream this?
right. Since we are almost halfway there in terms of participants, good morning, everyone. Ladies and gentlemen, welcome to the ANZ-MABC-MNZCC live webinar. I'd like to, on the onset, thank Ms. Tracy Ong and Koon Goh, who is our speaker for this webinar today. Mr. Andrew Bailey of the MNZCC is also with us, and we'll be welcoming you on behalf of the Malaysian New Zealand Chamber of Commerce. From all of us at the Malaysian Australian Business Council, we wish you a wonderful afternoon. I hope you are enjoying lunch while listening to Koon. I'm certain he's going to keep you occupied for the next hour. Andrew, over to you, please.
Thanks, Ramesh. Thanks for the introduction. And thank you to MABC and thank you for ANZ for letting MNZCC be part of the webinar today. So we're looking forward to a really interesting talk from Koon today. There's a lot of things happening in the world that I think everyone's very interested to see how that will be affecting Malaysia going forward. So welcome everyone and thank you very much. Please enjoy today.
Tracy, over to you.
Thank you, Ramesh. Thank you, Andrew. Good afternoon, everyone. Thank you for dialing in. Okay, my pleasure to moderate today's session. So on this topic, will the year of the tiger see Asian economies roar? Well, I think it was a nice topic, but I'm sure with the recent development, I think there are also some interesting development globally as well. So, okay, maybe some background before I hand over to Koon Goh. Let me just introduce some background on him. Koon, he's currently based in Singapore. He's the ANZ Head of Asia Research. Koon was born in Ipoh, grew up in PJ, Petaling Jaya, and attended Auckland University in New Zealand, where he graduated with a master's in commerce, just as the Asian financial crisis began. So he decided to apply for a job in New Zealand as the job market for fresh graduates in Malaysia were not looking good then. Managed to get a job in a consulting firm, and he subsequently moved to Wellington to work at the New Zealand Treasury, where he became manager of the macroeconomics forecasting team, responsible for the preparation of economic forecasts that underpin the budget. He also served as an economic advisor at the Reserve Bank of New Zealand. Koon joined ANZ in Wellington and subsequently transferred to Singapore in 2012, where he has been since then. Okay, that's a bit about Koon Goh. And before I hand over to Koon Goh to start his presentation, let me just go through some housekeeping. The presentation by Koon will take about 35 to 40 minutes, I guess, yeah? And then we will have Q&A for another 20, 25 minutes, yeah? So everyone is put on mute. So if you have any questions, kindly key in the Q&A box on the screen. Please feel free to type in your questions anytime throughout the presentation, and we will attempt to respond to all if time permits. So now let me hand over to Koon Goh to start his presentation. Koon, over to you.
Thank you very much, Tracy, for that introduction. And also thank you to Ramesh and Andrew as well. Thank you to MABC and New Zealand Chamber of Commerce for co-hosting this webinar. So let me just share my screen. Right, now the topic of my presentation is, we're in the year of the tiger, and at the beginning of the year, things were starting to look really optimistic. Unfortunately, recent events have sort of clouded the outlook somewhat, and I think it would be remiss of me not to start off the presentation by directly addressing that. And you will notice the topic of my presentation, I actually put a question mark at the end there, which is the last minute addition, because obviously the recent events could yet throw a spanner into the strength of the regional economic recovery. Now, in terms of what is happening in Ukraine, there are multitudes of impacts that could occur, and it is still very much early days at this stage. But one thing is certain, that wars typically are stagflationary for the global economy. And the question that we are having to grapple with is how drawn out will the conflict be, and how much further the ratcheting up of sanctions against Russia and will impact on the Russian economy. There's no doubt the Russian economy is probably going to implode given the unprecedented sanctions that have been imposed against it. Unsettling thing is that Russia is a nuclear power, and who knows what goes in the minds of Russian President Putin, and acts of a desperate man can be very unpredictable. The immediate impact that we have seen very clearly is the huge spike up in oil prices. And it's not just oil prices, but also wheat prices as well, because Ukraine is actually a major exporter of wheat. And Russia and Ukraine combined actually account for quite a large proportion of global wheat production that is exported. So not surprisingly, we have seen a spike up in oil and wheat prices. And this is the most immediate impact that the global economy and everybody else will be feeling. So it's going to get more expensive when you fill up your car. The price for your kopi and etc. will definitely start to rise in the coming months, as well as the effects of this price surge trickles through into the global economy. On top, and what's gonna happen is that you're gonna see huge inflationary implications for the global economy and Asia as well. So you can see here from the chart on the right, inflation in Asia has already started to rise as we have had increase in oil prices previously as the global economy was recovering. And as demand was starting to pick up, they were starting to generate more inflation. And now what seems to be a oil price shock is going to feed further into higher inflation pressures, which is going to put strains on households' disposable incomes. Now, the thing about the impact of the Ukraine conflict is, there are several channels that we can think of how they might impact on Asia. Now, thankfully, the first direct channel, which is the trade channel, is going to be very small. And that's because Asia's trade with both Ukraine and China is actually very small. So you can see here from the chart on the left, this is the total trade in Asia with Russia, which is now getting sanctioned and getting isolated from the global community. China has the largest trade with Russia, but even then it only accounts for just over 2% of China's total trade with the rest of the world. So it is actually pretty small, and it's not going to have a material dent on Chinese economic activity. For the rest of Asia, the trade with Russia is even smaller at under 1% of total trade. So the direct trade channels and any sanctions that are being imposed will not have a material impact on exports and hence economic activity. If you look at the financial linkages as well, thankfully, most Asian banks have very, very little exposure with Russia. So therefore, the sanctions that are being imposed, and of course, in terms of the large markdowns in Russian assets that we have seen since the weekend, will not have a material bearing on investors or the financial system in Asia. South Korea is the country with the largest exposure to Russia, but even then, that's only under $2 billion US. So the financial linkages are very small, and therefore there is nothing to worry about in terms of the stability of the Asian financial system. So the biggest impact that the conflict will have on this region through three channels. The first is the oil and commodity price channel, which I've talked about earlier. That channel is going to be very evident in the coming weeks and months in terms of rising prices that are tied to oil. So petrol is the most immediate one, but energy prices and all associated prices, including food, due to the spike up in wheat prices, will also start to become very evident in the coming weeks and months. So that the direct channel is the first one. And of course, with higher prices, that's going to erode household purchasing power, which will cause them to cut back on discretionary spending, and then acts to slow down economic activity. The second channel is the indirect channel, through the impact mainly on European growth. As I mentioned earlier, the direct trade with Russia is very small, but Europe as a whole is a very important trading partner for Asia. And Europe does have much more significant links to Russia. And there is no doubt that European growth will be impacted. You will see a slowdown. And in particular, given Europe's reliance on energy imports from Russia, which has already seen a significant spike up in prices, that's going to have a huge bearing on their households and businesses. So a slowdown in Europe's GDP growth is going to impact on Asia's exports to that region. So that's the indirect trade linkage that will start to flow through in the coming quarters and as well. And then the final channel in terms of the impact will be through what we call financial conditions. So this is where you have a sell-off that we're seeing in asset markets globally, investors being very cautious, and credit spreads widening. All these do have an impact eventually on economic activity through the financial channel. So this chart here on the right is our proprietary financial conditions index for Asia. It has a very close and leading indicator for real economic activity in the region. And we've already seen a tightening in financial conditions in recent months as markets were starting to price in increases in US monetary policy. But now with the Ukraine conflict, that has seen an even sharper tightening in financial conditions. Now, the tightening at this stage is not too worrying. It's nothing like what we've seen during the global financial crisis, for example. But it is still an added element that will act to slow down the economic recovery that had been already currently underway in this region. This is something I'm going to be monitoring very closely because this is a transmission that can change very quickly if there were going to be a material escalation. Now, so far, apart from the collapse in Russian asset markets, and of course the sell-off that we've seen in global markets, generally speaking, the impact on Asian asset prices has actually been quite muted. And again, that's because of the low trade linkages between Russia and Asia, for example. But if there were to be a ratcheting up of the escalation, and of course things could change, and we could start to see some contagion effects spilling through into Asia. But at this stage, I must say, things are fairly contained. There have been many banks already that have, and policymakers in this region that have declared that the exposure to Russia is very low. So that gives me confidence that Asia is in a good position to weather the situation. But nonetheless, there will be downside risks to global growth. I think that is pretty much a given. Now, prior to the conflict, we were anticipating a slowdown in global growth already a very strong rebound in 2021. The IMF was forecasting a GDP growth of over 4% in 2022. That's actually a well above trend growth rate for the global economy. But now we are probably looking at further downgrades to that, potentially sub 4%. There's no doubt the Russian economy is going to go into a deep recession as a result of the sanctions. As I mentioned earlier, European growth will be marked down, and the oil shock will also have repercussions for other countries as well. So downward revisions to global growth is pretty much a given. However, we are still anticipating at least 3.5% or so global growth, which is still a decent rate. Obviously not as strong as what we had previously. Now, the other implications that this conflict will have is on supply chains. I'm sure all of you have heard and read about supply chain constraints, shortages of certain materials like microchips, etc., that have hit the global economy since the pandemic. And the conflict will only exacerbate these supply chain constraints. This chart here on the right is an indicator compiled by the Federal Reserve Bank of New York, which tries to quantify the extent of supply chain constraints globally. And you can see it's at a very unprecedented level due to the disruptions that the pandemic have brought forth. And the conflicts in Ukraine will further exacerbate this. And to be honest, some of the sanctions that have been imposed on Russia is unprecedented in its nature. For example, never has a major central bank been effectively cut out from the financial system. And many governments have announced that they are cutting trade ties with Russia. Global shipping companies are now not going to be transporting doing business with any Russian entity. So there's going to be further global repercussions from this, which is actually going to cause further disruptions to supply chains as well. Now, the bottom line from all this, apart from a slowdown in global growth, is that inflation, which is already very high at multi-decade highs in some countries, is simply going to worsen. So commodity prices have spiked up. I mentioned oil, I mentioned wheat, but we've seen many other commodity prices rising very strongly as well. Food prices are going to spike up, partly on account of what's happening to wheat prices, and container shipping rates will continue to stay elevated because of the supply constraints that it's set to drag on. So all these are hugely inflationary and will manifest itself in the coming months through inflation numbers right around the world. At a time when US, European, and global inflation has already risen very, very strongly. So there's unfortunately no end in sight to the huge inflationary pressure that had built up. Now this begs the question, with inflation already high, we've already seen the US Federal Reserve sound very hawkish and looking to hike rates very, very soon. Will the conflict cause the US Federal Reserve to pause on their rate hikes? Sadly, the answer to that is no. At this stage, I do not expect the US Federal Reserve to back off. They are already having to deal with overheating US economy, a labor market in the US that is very tight, leading to very high wage inflation. CPI inflation in the US is already at a 4-decade high, and that's all before this conflict caused the spike up in energy prices. And if you look at what the Fed has done during the pandemic, they have provided ample liquidity to the global financial system. This chart here on the left shows US money supply, and you can see the huge unprecedented spike up in US money supply when the pandemic hit. Now, the US economy is now at a stage where it doesn't need that emergency policy accommodation anymore, which is why the Fed is getting ready to start to tighten liquidity. So the Fed will not shy off from hiking rates later this month. The market is still pricing in at least 5 rate hikes from the US Federal Reserve by the end of this year, which will take the Fed funds rate, which is currently 0.25%, all the way to 1.5% by the end of this year. So higher US interest rates is pretty much a given, and it will take a major escalation of the conflict in Ukraine and material downturn in the global economy for the US Federal Reserve to back off on that. So unfortunately, we are looking at an uncountable cocktail of supply shocks, oil price spike, downward revisions to global growth, and higher US interest rates as well to contend with. Now, fortunately, Asia at this point in time is actually in a decent position to cope with some of these shocks that are coming. For a start, Asia has built up quite a formidable external buffer to withstand these shocks. The region's current account surpluses has improved in the last couple of years. The pandemic has actually brought on an export boom for some economies, particularly those that are heavy in terms of technology exports, and that includes Malaysia as well. So the current account surpluses have reached multi-year highs, and that provides a very important cushion to be able to absorb the higher oil prices. FX reserves in the region have also been built up by central banks, and this provides a very important war chest that they can employ in order to try and smooth financial market volatility. And if there were to be a massive sell down in Asian currencies, this is where Asian central banks can deploy their formidable FX reserves war chest to try and smooth the excessive volatility. And I think it's also important to remember that the growth trajectory for Asia is actually starting to pick up. So that's actually quite important, because when you have an economy that is starting to expand and recover, that also provides you with quite an important buffer to absorb some of the slowdown that no doubt is going to be occurring in Europe. And I think one other thing I should mention as well is that while the Fed is expected to start to tighten interest rates, that does not necessarily mean that the US dollar will continue to appreciate. Now, of course, we've seen the US dollar strengthen since middle of last year, and recently it has strengthened on the back of the heightened uncertainty, as the dollar is still seen as somewhat of a safe haven. And we've seen, of course, some capital flight towards the US dollar. However, these things tend to be temporary, and if history is any guide, once the US Federal Reserve starts to hike interest rates, we actually tend to see the US dollar start to decline. So this chart here just shows since 2000, what happened to the dollar in the previous 2 Fed tightening cycles. Back in 2004 to 2006, when the Fed hiked successively, the dollar actually declined and Asian currencies appreciated during that period. And it was a similar pattern that we saw during 2016 all the way to 2018, the last time the Fed also embarked on a tightening cycle. The dollar actually declined and Asian currencies also appreciated. So this, I suspect, would be how things will play out this time around as the Fed starts to embark on a hiking cycle later this month. I do expect the dollar to eventually start to depreciate. That's assuming the conflict doesn't escalate further and we can hopefully see some stabilization in that region. Then the dollar will start to come off as the safe haven demand starts to ease off. And also, the Fed is not going to be the only central bank to be hiking rates. Other central banks will be joining the Fed in hiking rates as well. The Bank of England has already started to hike. Reserve Bank of New Zealand has already started to hike. Reserve Bank of Australia, we expect to be hiking later this year. In Asia, the Bank of Korea and the Monetary Authority of Singapore have already started to tighten policy ahead of the Fed. So again, I think it's important to put things in perspective. While the Fed is a very, very important central bank and the focus of global markets, there are other things that also impact on the dollar. And once the Fed embarks on the rate hike cycle, other central banks will also be looking to follow suit, especially given the upside inflation risk, and that will start to take some of the heat off the US dollar. Now, moving on closer to home in terms of how the economic outlook for Asia is panning out. Like I said earlier, I think the starting point for Asia is looking very positive. Late last year, when Omicron first started to emerge, there were a lot of concerns that that might derail the recovery. But as of now, what we do know is that Omicron, whilst a lot more infectious than Delta, is proving to be a lot less lethal, and the recovery time is also a lot faster. So this chart here on the left shows global COVID cases, and you can see the massive spike up globally in the early part of January. But then the tide has turned and we're starting to see cases come down very, very sharply. If you look at South Africa, which was where Omicron originated, we saw a similar pattern, a huge spike up in cases, but then a huge collapse just as quickly as well. And again, I think the experience of South Africa is quite telling, because South Africa actually has a very low vaccination rate. Only about 30% of their population is vaccinated. And despite that, we have not seen significant deterioration. We have seen confirmed cases fall very rapidly, and very importantly, the number of fatality was not anywhere near as high as the previous COVID peaks. So that tells us that Omicron is more infectious, which we all know, but a lot less to be concerned about from a health outcome perspective. So that's why that has given governments around the world more confidence to continue with plans to open up their economies, ease back on restrictions, and that is the important catalyst that will drive the recovery in the region. Helping this is the fact that vaccination rates right across Asia has reached the critical threshold that has been seen to allow for reopening and to help manage adverse health outcomes. So this chart here on the left shows, as of now, the current vaccination progress throughout the region. Singapore has the highest vaccination rate, and with the booster shots now underway, I think just over half of the eligible population have already received their boosters. Malaysia's vaccination rate is also very high, which is why they can continue to progress with a continued opening up. There are a few other countries that are lagging behind on vaccination progress, such as the Philippines, for example, but no doubt as the year progresses, we will see them start to catch up. So given that there is less to fear about Omicron, it is really onwards and upwards in terms of easing off on restrictions, and more governments are moving from pandemic to endemic in terms of managing COVID-19. So with the easing of restrictions, we've already seen mobility start to normalize. Lockdowns are a thing of the past, and activity, whether it's travel to work or just movements to shops, have largely returned back to pre-pandemic levels, as you can see here from the chart on the right. So that's helping to drive a strong recovery in domestic demand, and the Q4 GDP numbers that have been reported from across the region attest to that. We've seen a very sharp rebound, especially in ASEAN, of domestic demand in Q4 after very sharp contractions in Q3. Q3 was when Delta was still wreaking havoc and there were tightening restrictions. So that severely impacted on activity then. But Q4 has seen a strong rebound, and I have no doubt we're going to see a continuation of that strong rebound in the early part of 2022 as well. And what is going to further add to that rebound in domestic demand is the opening up of international travel as well. I think this is a next important critical step in really driving the recovery in the region. Tourism is an important part of economic activity in the region. It differs for different economies. Thailand is the most reliant. Almost 15% of the GDP was reliant on international tourism before the pandemic. Tourism is also an important part of Malaysia's economy as well. But now with travel opening up in some countries and hopefully in Malaysia, very, very soon, they will start to welcome the return of international visitors. This will be an important part of driving services exports and economic activity as well. Now, there's actually a lot of pent-up demand for travel that have built up. A lot of people have been stuck for almost 2 years now. And if you take the example of Singapore, for example, which just started to open up travel through vaccinated travel lanes from October, there's been a massive pickup in travel demand. This chart here on the left shows Singapore Airlines passengers carried and their capacity. You can see the massive collapse when COVID started, and then the huge rebound once the vaccinated travel lanes opened up. At the moment, of course, it's still 20% of pre-COVID capacity, but as more and more vaccinated travel lanes get announced and more countries start to open up and welcome international travelers, I have no doubt the international travel numbers will continue to pick up and recover. And this is coming at a very important time because merchandise goods exports, which had been very strong in the last 2 years, which had been a major driver of the region's economic growth during the pandemic, is set to slow down. The sort of strong growth rates that we've seen in the last 2 years simply cannot be sustained. We've already started to see signs of that slowing down already in the recent data, and especially with what's happening in terms of the Ukraine conflict, I'm sure you're going to see a further slowdown in export growth going forward. Now, we are talking about a slowdown, not a collapse, very important. But exports will slow nonetheless. It won't grow at double digits anymore. It'll be more the single digits growth, which means the contribution to growth will slow, which is why it's very important that international travel starts to pick up, because it will start to make up for some of the reduced contribution to growth that's coming from the external sector. Now, of course, it would be remiss of me not to mention what is happening in China. The outlook for ASEAN, I think it remains positive. As restrictions ease off, domestic demand picks up, borders start to open up. But China has gone through quite a rapid slowdown in the past 12 months. And a large part of that is actually due to the slump in the property sector. And at this stage, there's no indication that the slump is over. The property sector crisis in China looks like it will continue to drag on, unfortunately. At this stage, though, there are no signs that it is spilling over more broadly into the rest of the Chinese economy. This chart here on the left shows China Evergrande share price, which is down about over 90% since its peak, versus the broader China real estate developer index and the broader Shanghai equity market. So China Evergrande, definitely no signs that things are going to improve anytime soon. The broader developer index also showing that the near-term outlook is somewhat bleak. But for the broader China market, it suggests that activity outside of the property sector is still doing reasonably okay. So there's no evidence of a broader spillover. certainly no evidence that what's happening in the property sector is going to drive the Chinese economy into a hard landing scenario. And Chinese authorities still have a lot of ammunition to provide support to the Chinese economy if there is a need. Indeed, in recent months, the Chinese government has already started to provide support in the form of cutting interest rates, cutting RRR, directing banks to ease up on lending to households, and we're starting to see credit growth starting to pick up. So this chart here on the right shows the credit and fiscal impulse, which had been quite tight over the course of 2021. Part of that is done on purpose as China was trying to rein in excessive leverage in the property sector, which is partly what contributed to the crisis they are in. But they're starting now in the process to ease back on some of that. So that will help to provide support to the non-property sectors in China. And the China export sector is still growing quite strong. Chinese exports still expanding at double-digit growth. So there are still pockets within China that are still doing reasonably okay. The big wild card is China's COVID-0 strategy, which they are still pursuing at this stage, even though the rest of the world is starting to move towards an endemic stage. How long more China will stick to their COVID-0 strategy is the big unknown. But if they were to start to ease off on that, again, there's going to be a very powerful catalyst to see a more meaningful pickup in Chinese growth as well. So at this stage, the way we look at overall GDP growth for the region this year, we're looking at a 5% growth for China in 2022. This is a slowdown from last year's 8.1%. As I said, a lot of that slowdown is driven from what's happening in the property sector. But other parts of the Chinese economy is still doing okay, which will help to offset that. We're definitely not looking at any hard landing type scenario for China. So more of a stabilization of growth at around 5%. And if the authorities start to ease back on their COVID-0 strategy and provide more policy support, then we could see a more broader recovery from China towards the end of 2022 into 2023. For ASEAN, we are forecasting an acceleration in growth from 2021. 2021 in ASEAN was a difficult, challenging year because of the impact of the Delta variant that saw renewed restrictions being imposed, which caused a downturn in activity. But this year, with restrictions continuing to ease off, with borders starting to open up, we are forecasting an acceleration in growth to 5.5%. And in Malaysia's case, we are forecasting a much stronger pickup from the 3.1% growth last year towards 5.7% for 2022. And in terms of how we're looking at the Malaysian economy right now, yes, COVID cases are still high, but as I said earlier, there's less concern about the health impact of that as Malaysia too starts to move towards the endemic stage. Quite importantly, there has been a pickup in business confidence amongst businesses, and this has also been reflected in pickup in the number of new companies that have been registered, as you can see here from the chart on the left. So this improvement in business confidence is important. New businesses starting up is important because that tells you that with increased confidence means there's going to be a likelihood of an improvement in investment and hiring, which will help to drive the recovery in the economy. And indeed, we've already seen that in the labor market. This chart here on the right shows the Malaysian unemployment rate, which had been falling. It's still above where it was pre-pandemic, but the direction of travel is heading in the right space. I think importantly, if you look at labor force participation, it's actually recovered to the highest levels on record and above pre-pandemic levels. So more people are entering the labor force, looking for work. And that's going to be, it's coming at a good time as businesses are now looking to expand. Confidence is back. So hopefully we're going to see a pickup in hiring, which will be very supportive for household incomes and consumption. Now, despite the fact that the unemployment rate is still higher than what it was pre-pandemic, there's already areas of labor shortages in Malaysia, particularly in the service and hospitality sectors. Of course, part of that could be due to the fact that borders were closed, so the traditional source of labor from other countries have been closed off. So there's been tightness there. But again, that also tells us that there's going to be wage inflation pressure that's also going to be starting to build up as well in Malaysia. That's something that businesses will need to manage quite carefully alongside, the higher inflation that's already happening and that's going to happen throughout the course of this year as well. Now, one of the positive aspects for Malaysia is that the spike higher in energy prices as a result of the Ukraine conflict is going to be a partial beneficiary for Malaysia. Now, I know if you're a consumer, there's cold comfort for you. You're going to be paying more for your petrol price. But Malaysia as a whole will benefit because Malaysia is a energy exporter, particularly LNG, and also a major exporter of palm oil. And oil prices and palm oil prices has also spiked up as well, as you can see here from the chart on the left. So that's going to provide a very important boost to Malaysia's exports. Petronas is back running profits, and also very important for the government's fiscal position as well, because that will ensure that the dividend from Petronas to the Malaysian government will be substantial, which will help the government maintain spending to continue to drive the recovery in the economy. One thing that is not benefiting from the high oil prices is the ringgit. You can see the chart here on the right. In the past, there has been a very, very strong correlation between oil prices and ringgit. Every time oil prices is high, that tends to drive the ringgit stronger. This time around, when oil prices pass $100 a barrel, the ringgit hasn't really benefited from that. I think there's a couple of reasons why there's been this big disconnect now compared to last time. One is, of course, the ongoing investor uncertainty because of the conflict. This is a pure supply shock. Oil prices are driven higher because of the conflict, because of war, not because of extremely strong demand. So that's why there's the disconnect. Secondly, we're expecting the Federal Reserve to start hiking rates, and that is keeping the dollar strong for the time being and hence suppressing the ringgit. But if Bank Negara were to start to follow the Fed and hike rates, which we expect them to do later this year, that's when we'll start to see the ringgit start to appreciate slightly and really start to benefit off from the high oil prices. And finally, whilst we're expecting the Malaysian economy to recover to 5.7% this year, I think it's very important to also remember in terms of real GDP levels, the growth rate might look quite good, but Malaysia still has a long way to make up for the lost output. Effectively, you had 2 years where COVID has wiped out growth, and the Malaysian economy is still about 8% below where it would be pre-pandemic. In other words, if the pandemic had not happened, the level of GDP would be 8% higher than what it was now. In other words, living standards for everyone in Malaysia would have been much higher than what it is now. So while Malaysia is starting to emerge from the pandemic effects, looking at a recovery in growth, it's still a long way to fully recover from the effects of the pandemic. And I think the tourism sector also has a long way to climb. So you can see here the chart on the right, once Malaysia starts to open up, you will start to see tourist numbers start to pick up. Most importantly, if they can start to open up the causeway with Singapore, they will definitely see a massive pickup in visitors from Singapore. But as long as Chinese tourists remain at home, and as long as China pursues their COVID-0 strategy, it's going to take a long time before tourism can get back to pre-pandemic levels. Chinese tourists account for a significant part of Malaysia and Asia's overall visitor numbers pre-pandemic. And until China starts to open up as well, I think it's going to be a long, slow grind for the tourism sector to fully recover as well. And again, that is part of why it's going to take a while before Malaysia's overall GDP will get back to pre-pandemic levels. But at least we're starting on a recovery path. I think the outlook is definitely more optimistic this year. The Ukraine conflict, I think, is definitely a potential downside risk. I'm hoping that it will not turn into anything too material that will derail the Malaysian recovery or the global recovery as well. So that's it in terms of my presentation. Thank you very much for your attention. I'll pass on to Tracy now to moderate.
Hey, thanks, Kun. That's very, insightful. I think a lot to digest as well. Okay, now we shall go to the Q&A. I think there are a couple of questions already, there. I will just read them out. Yeah, I think the first one is, is on the global situation. On what if China? I think that's on the Ukraine and the Russia matter. Yeah. What if China inevitably get involved? What is the possibility and the impact on Asia, I think? Yeah.
Okay. Get involved, I'm assuming when you say get involved, okay, there are various ways of getting involved. Okay, number one, China is actually against the Russian move. China is all for not meddling into other countries' business. Certainly, Xi Jinping will not view what Putin has done and definitely will not give support. Having said that, they are not openly condemning it, but they are not supporting it either. So I doubt very much China will get involved, either through joining the rest of the world in terms of sanctioning Russia, or get involved in terms of providing direct support for Russia one way or another. I think they will pretty much stay neutral. But I think one thing from an economic point of view that is, I think, very evident is that because Russia is now basically closed off to the rest of the world, and Europe will increasingly look to reduce their energy dependence on Russia. Russia will increasingly look to sell more of their products to China. So the Russian economy will become increasingly more dependent on China. And Russia actually has what China wants, which is energy. And also because of the US sanctions, which effectively cut off dollars from Russia, they also probably forced Russia to start to use the renminbi directly. So I can see some longer term economic repercussions from this, from a trade, finance, economic linkage where Russia and China will get closer. But China will not directly get involved one way or another. They will help Russia out indirectly by buying more things from them, by getting closer economically, but they will not get directly involved. That's my view.
Thanks, Kun, for that. I think there's really a conflict that China is, the situation is really, well, let's see. Hopefully, it comes, it won't get worse. The second question is that, earlier you were saying that Korea is more dependent on Russia. Is it due to the oil and gas imports? How about America? I mean, they are quite reliant on Russian oil and gas as compared to the Ukraine commodity supplies.
Okay, so when I say Korea is Korea is not dependent on Russia. All I'm saying is that Korea has the biggest exposure in terms of the banking sector to Russia, but even amongst Asia, but even then it's very small at under $2 billion. So in perspective, it's actually very, very small. It's very insignificant, and therefore that's why I'm not too worried about any repercussions on the Asian financial system. Even in terms of the broad exports and trade, it's actually very, very small. So I'm not concerned at all. I see very limited impact from the trade and financial linkage. The other question was on the US, right? You mentioned, Tracy?
Yeah, that's right.
Yeah.
I think it's about America, yeah.
Okay, so America is actually not reliant on Russian oil and gas. Europe is, in particular Germany. Believe it or not, the US is actually now a net oil exporter, thanks to the fracking revolution of a few years ago. So the US now is actually in a much better position to withstand the oil price shock. Europe is a different matter, however, which is why the sanctions being imposed against Russia and their banks do not cover energy trade. So you sanction the banks, you sanction everything else, but in terms of energy transactions, that is still allowed to go through. So this is the issue that Europe faces at the moment. They can't just cut off buying oil and gas from Russia because you can't. It's not something that you can suddenly switch to an alternative market to replace overnight. So that's why they're trading very carefully. But over time, I believe they will look to reduce their dependence and look for alternative suppliers. Now, again, in this regard, particularly when it comes to gas, what are your other alternatives? Middle East, of course, Qatar is a major gas producer. Malaysia, of course, huge LNG exporter, and Australia as well. So again, there could be potential medium-term benefits if Europe were to start to source more of the supply from other places. But of course, there's also logistical difficulty because at the moment it's because of the pipelines that infrastructure is already in place. That's why it's easy for Europe and Germany to import the gas. But if you want to import gas from Middle East or Malaysia, it's not that simple. The infrastructure is not set up. So again, these things will take time.
Right. Thanks. Okay, thanks for that. I think the next question is more closer to more domestic. I think. Okay, let me see where it goes to. Okay. While Malaysia has significant current account surplus, it also has significant external debt. Then with the likelihood of Fed rate rise and weakening of ringgit, so the cause of concern. Maybe I read the next question as well. Is there a question for that? The second one is for Malaysia in particular, apart from tourism-related activities, which economic sectors do you think stand to benefit when borders reopen?
Okay, so in terms of the external debt situation, yes, Malaysia has external debt, but a large part of the external debt is in terms of the serviceability is actually quite comfortable. So even if the Fed were to continue to raise rates and hike 5 times or even more, yes, debt servicing costs will increase, but I don't expect that to cause undue stress on the ability of Malaysian corporates or the government to service that debt. In the case of the sovereign anyway, most of the debt is ringgit denominated. So ultimately, there's no currency issue. For corporates, again, that is sector and company specific, but if companies have natural hedge, then again, there's less of a concern if there were going to be a strengthening in the dollar because you do have earning in foreign revenue, so that should be sufficient to cover. Broadly speaking, if you look at Malaysia's overall external vulnerability, it's not at a level that is too concerning. And in any case, I think Bank Negara has ample FX reserves in order to help to mitigate any undue volatility there is. In terms of the second part of the question, in terms of tourism-related activities, I mean, tourism is a very broad sector. There's a lot of companies that are involved, ranging from, single stall operators to large companies. So really, it's depending on which market is targeted and how Malaysia opens up the tourism sector. Is it going to be big bang, or is it going to be targeted like what, for example, Indonesia is doing? Indonesia is opening up Bali, for example. Thailand started out with Phuket Sandbox before eventually opening up to the rest of the country. So how Malaysia decides to open up will be important in terms of the locality of the sectors that will benefit. But typically, like airlines, transport companies really tied to tourism, hotel, hospitality, those are your direct beneficiaries if there were going to be a large resumption of travel. And of course, as I mentioned earlier, if the border crossing between Singapore and Johor were to open up, I can expect the usual weekend flood of Singaporeans to Johor to shop for leisure, and will definitely open up. So that'll definitely benefit the businesses around Johor and Johor Bahru.
That's right, especially the restaurants. I think there'll be the food industry. Okay, I think we have another 2 minutes, but there are 3 more questions. So very quickly, I read them. Understand that BNM will only raise rates in the 3rd quarter, given that most countries are raising rates. What are your views and impact on inflation and ringgit?
That's the expectation. We're expecting Negara to start hiking rates from the 3rd quarter onwards. But we don't think there'll be in any hurry, because inflation at the moment is still manageable in Malaysia. But of course, there's a lot of upward pressure on inflation. So inflation is expected to accelerate given the oil price shock. And the domestic economy is recovering, as I mentioned earlier. So Negara will look to start to hike rates in order to ensure that inflation doesn't get too high. In terms of how that will impact on the ringgit, I think the ringgit is caught between several competing forces. Where oil prices are at the moment suggests that ringgit should be a lot stronger, but it's being held back by other external geopolitical factors. So if we get an easing of those factors, and if Negara starts to hike later this year, then that's when we can expect ringgit to start to recover somewhat towards the end of the year and start to appreciate, especially if oil prices were to still stay elevated.
Okay. Next question is how about forecast of gold prices due to the ongoing war?
Yeah. So gold has benefited from safe haven demand at the moment, and if there were a further deterioration in the situation, we could see gold heading to $2,000 an ounce. But by the same token, if there were going to be a de-escalation, if things sort of settle down, then gold will just as quickly start to come off. But given high inflation globally, that tends to be positive for gold. Gold is seen as an inflation hedge. So any pullback in gold will probably be not significant. I think our forecast for gold probably has it well supported around $1,700. So I think sort of around the $1,800 range, I think seems quite appropriate if there were going to be a backing off of tensions by inflation globally remaining high.
Okay, thanks for that. So next question is, coming back to our home ground, how badly affected will Malaysia face financially and trade with the world?
I assume the impact is due to the Ukraine conflict.
Yeah.
Like I said earlier, I think the direct trade and financial linkage is very low. So there is no concern at all at this stage. And I think Malaysian banks have very, very little exposure to Russia anyway. So there's not going to be any of that direct impact. The biggest impact will be through the trade linkage with Europe. If there were going to be a material downturn in European growth, that's where he'll hit Malaysia. If there was a broader sell-off in markets, equity markets globally, fall sharply, they'll tighten financial conditions. So yes, that's going to be the indirect channel that's going to impact on Malaysia. But Malaysia does have offsetting impact because by virtue of it being an energy exporter. So again, a bit fortunate for Malaysia. Malaysia and Indonesia are the only two countries in this region that are net energy exporters that at least have some offset, whereas other countries don't. So at least for Malaysia, you have something that they can benefit a little, but of course the net negative effect is larger. But in totality, I don't expect it to have a material impact. That's why I'm still expecting the growth recovery in Malaysia to still be on track. Still expecting growth to accelerate from last year. But of course, there's some downside risk to that growth. Maybe the growth acceleration might not be as strong as what it was in the absence of the Ukraine conflict.
Yeah, thanks. Good to know that. Yeah. Okay, I think we are past the hour. Just one final question. Do you think the GDP for 2022 of 5% or more is achievable given ongoing things? I think the volatility locally and globally. So what's the downside?
Yeah. Look, I think when you're dealing with geopolitics and especially a war, the downside repercussions can be large, right? I mean, we're talking about Russia's nuclear power. I mean, you can think of the absolute worst case scenario. Could be really, really bad. But at this stage, I think we are not, or we are citing a very, very low probability of like the absolute worst case outcome. At best, all we can do is monitor, pray for the best, prepare for the worst. So at this stage, I still think 5% growth is achievable for Malaysia, but that is predicated on the situation then not further deteriorating a whole lot more.
Okay, thank you. Thanks, Kun. All right, everyone. I think we have come to the end of the webinar. It's already, I think, 5 minutes past 1. So thank you, everyone, for taking time to join us. And I hope you find it informative and useful. If you have any further questions, please feel free to email them to the MABC Secretariat. Yeah? Before we end, a special thanks to my colleague, Kun Go, for taking the time from your busy schedule, Kun, to share your thoughts and views with everyone here. It's always good to have you with us. So thank you, everyone. That's the end of it. Take care and please stay safe.
Thank you. Terima kasih. Bye.
Thank you.